holding the seminar.
Great. So welcome everybody, ever so slightly delayed to our 115th Reading Online Sport Economics Seminar. At this time of football watching, we're going to take another week away from football, and after baseball last week, we're on to poker and online poker this week. Just before starting, I want to flag up a couple of things. The first one is a survey being conducted by two prominent female sport economists, Katrien Schaffenkamp and Pamela Vicker, working out of Bielefeld University, and they have a survey that they are keen for you, or for PhD students and postdocs to fill out. I will put the link to the survey in the chat in a few moments, and if you do want to fill in that survey, that would be really helpful for the research project. I'll put a few details in as well. And if you do want details from me and you can't see the chat, drop me an email. I can forward on the email to you. And the only other thing to say is, as you may be aware, during the World Cup semi-finals, so December the 13th and 14th, we're having a second Reading Football Economics Workshop. And we have Jorge Tovar and Justus Haukap, as well as Christina Philippou as keynote speakers. And if you want to join us in Reading, again, please do drop me a line. I will put, again, a link in the chat if you want to register for the conference. And without any further delay, Markus Dertwinkel-Kalt is going to present Skewness Preferences, Evidence from Online Poker. All yours, Markus.
Exactly. So thanks a lot for the very kind invitation. Very happy to be able to present here in this really interesting seminar. I find it quite amazing that you organize such a sports economics seminar. Unfortunately, the timing is not so great for me that I couldn't attend so often. So nevertheless, very happy that I can present here today some work together with Johannes Kasinger from Frankfurt. He's on the job market this year and he's great, so invite him if you have some jobs at your institution. And it's joint work with Dimitri Schneider, who's also great, but who wants to stay in Düsseldorf, but he organized here all the technical stuff for me today. So happy that this now worked out. I didn't know that it's such a problem to share a screen with Microsoft here on a Apple laptop, but it finally worked out here. So I'm presenting a paper on online poker called Skewness Preferences, Evidence from Online Poker. Please interrupt me if the connection wouldn't be so great, then we could improve here things, or please interrupt me if you don't see the presentation anymore, etc. With all technical problems, please interrupt me immediately. And please also interrupt me in case you're lost, in case you have any questions, you can interrupt me all the time. So probably you're not all familiar with skewness preferences. So before I come to this paper, let me first explain you briefly what skewness preferences actually are. What are skewness preferences? Well, skewness refers to the central standardized third moment of a probability distribution. So first moment is expected value, second moment is variance, third moment is skewness. And here in the middle, we have a symmetrical distribution. On the left-hand side, we have a distribution with a positive skew, and on the right-hand side, we have a probability distribution with a negative skewness. A right skewed distribution means that you have a tail on the right side of the probability distribution that is long. That means you have a large positive payoff with a small probability. You see that here at the end of the long right tail. That means a very positive event happens with just a tiny probability. Then on the other side, you have a negatively skewed return distribution, which means that you have a long tail on the left side of the probability distribution. This means that there's a large negative payoff that is realized with a small probability. So this means skewness. And what's now preference for skewness? Well, preference for skewness or skewness preferences are defined as a preference for right-skewed risks and an aversion toward left-skewed risks. So you like those risks here that have a positive skew. These are lottery-like risks with a tiny probability you become a millionaire, and you dislike the negatively skewed risks whereby you just lose a large amount with a tiny probability. So a disaster happens with a tiny probability. These are those events that you dislike, and to avoid these risks, you're willing to pay quite a high premium. And this is denoted in the literature skewness preference. So you like some risks and dislike other risks. So skewness preferences can explain the success of expensive insurance contracts, so where you pay a very high premium to avoid negative events, or that you prefer insurance contracts with really low deductibles. You pay a very high price to get an insurance contract with just a tiny deductible, even though you would think it's not really worth the money. And skewness preference can also explain, on the other hand, why you like other risks, why you find lottery-like gambles so attractive, why you engage in gambles that give you, in expectation, quite a negative return, but nevertheless, you like this tiny chance of winning a lot so much that you pay a lot to engage in such gambles. And these skewness preferences are particularly important on financial markets. So it explains you why some assets are very attractive to investors and others are not. And then on financial markets, you can observe a skewness premium, that those assets that have positively skewed return distributions in expectation, those are those that are rather overpriced. Skewness preferences can also have an effect on career choices. So people want to select into occupations where they could become rich with a tiny probability. For instance, they like to become soccer superstars, where they just have a tiny probability to have the breakthrough. But if they have this breakthrough, then they become really rich and successful. And there are papers that show that such occupation clusters that should be attractive according to skewness preferences indeed are very attractive, and people excessively select into such occupations. So that's a short motivation for skewness preferences. So why skewness preferences should be interesting also for those who don't work in decision theory, who actually don't work so much on choice under risk. It's just relevant in many domains. And skewness preferences are not coherent with expected utility theory or Markowitz standard portfolio theory. So skewness preferences, sorry, I lost the screen here. Just not used to this. Sorry. So skewness preferences cannot be explained with the standard economic approach. Why? Because in expected utility theory or in standard portfolio theory, you either like risks or you dislike risks. You're either a risk averse or risk seeking. And skewness can change your risk attitudes. So standard assumption in expected utility theory is curvature in your utility function. So in EUT, you typically assume that people are risk averse. But that means that risk-averse individuals in EUT will never choose skewed risks over a safe alternative with the same expected value, no matter how skewed the risk is. So if somebody is risk-averse in the EUT sense, he will not choose these lottery-like positively skewed risks. Right skewed risks or positively skewed risks are denoting the same. So these are not attractive to EUT agents. EUT agents that are risk averse are always risk averse, also if they face a positively skewed risk. So how can skewness preferences now be explained? Skewness preferences are predicted by theories of nonlinear probability weighting. So all those models that say that you overweight tiny probabilities, they can explain skewness preferences. And that prospect theory can explain skewness preferences was also one major reason for the success of this behavioral model, but also other behavioral models such as regret theory or salience theory or disappointment aversion and many other behavioral models predict skewness preferences. Whereas EUT standard models can explain why people react so strongly to skewness. Now, what evidence is actually out there that shows that people indeed like skewness so much? Well, the evidence either comes from stylized laboratory experiments. I've also conducted such experiments where we identify skewness effects in quite artificial choice situations with selected samples and small stakes. So you can identify skewness in the lab, but yeah, just in quite special situations that may not be so representative for real-world decision making. And skewness effects are also observed in field studies with observational data. These studies, however, have other problems. These observational field studies cannot cleanly identify skewness effects. Why? Well, the underlying probability distributions are typically very complex, just estimated on past data, and actually also unknown to the decision maker. So for some asset or some stock, for instance, the Tesla stock, what is the return distribution if you invest into the Tesla stock? Well, you could somewhat estimate it based on past returns, but it's actually not so clear. Is it positively skewed? Is it negatively skewed? You need really strong assumptions, and it's also plausible to assume that the investor actually is not so sure what is the return distribution of a stock when he invests into that stock. So the finance paper that tried to disentangle skewness effects, they somewhat estimate the return distribution and then find out that some stocks have a more positively skewed return distribution in expectation, others a more negative return distribution, and the way of estimating that is really difficult and needs some ad hoc assumptions. And then these finance papers assume that the investor precisely knows whether the asset he invests into has a positively or negatively return distribution, and then they find some overpricing of those assets where they think they are most likely giving rise to positively skewed return distribution. So it's also not so clear that the investor does all these calculations likewise, that he's really aware of such things. So it could be that these skewness effects on financial markets are not really there, that things are driven by other things. The finance papers can just identify these effects so clearly. So ex-ante skewness is only approximated and actually not really known to the decision maker. So there's evidence for skewness from stylized lab experiments that can cleanly identify skewness preferences in these artificial choice situations. And there are these very complicated field settings where nobody actually knows the precise distribution. Researchers can approximate them, assume that the investor knows them, and then they can somewhat identify skewness effects based on very strong assumptions. So we here in this paper want to provide a direct test of skewness preferences in a setup that combines the advantages of lab experiments and of observational field studies. So to combine the advantages of both and get rid of the disadvantages of both. So we want to combine the favorable features of both of these approaches here. How can we achieve that here? Well, we here in this data set have decisions between a safe option and a binary risk. Binary risk, I'll show you later on, is uniquely determined by its first three moments: expected value, variance, and skewness. These probability distributions are as simple, as clear, and as transparently displayed to the subjects as possible. No risk can be easier than a binary risk. Very clear, very transparently displayed to the subjects. So this we regard as a big advantage over field studies. It's so clear what the probability distribution here actually is. Then we have a large and unique panel data set of real-world choices coming from online poker, from 1.5 years of online poker players, with very high incentives. So the mean of lottery's expected value is more than $60. So the disadvantage from lab experiments that we just have a tiny number of subjects, that the expected value of each game is so small, we can get rid of in our settings. And individuals in our sample also have a comparably good understanding of risks and probabilities, because poker players can be assumed to be quite experienced, so they know what they react to. And we have more than 80,000 online poker players that face repeated choices between a binary risk and a safe option. So we have a real-world setting where nevertheless the risk distributions are very clear, very simple, and so we can assume that subjects know what they're doing here. And we have this very large number of observations. So this is what this paper is about, and what I want to explain you in the following. Are there any questions so far? Otherwise, let me come to a preview of our results. So
there is one question, Markus, from Ian Smith.
Yeah.
Hello, can you hear me?
Yes.
Yeah. So I was wondering maybe another advantage of your setting. So you were mentioning about expected utility theory not being able to cope very well with these skewness preferences.
Yes.
So I wondered if in some of the examples you gave, like I play the lottery, but I also insure my car, whether that can be reconciled with expected utility if there's something other than the money that I care about. So my utility is somewhat broader than the money. So I really want to win. I want to be a hero by winning the lottery. And I really, if I crash my car, my day would suck, right? And it would suck a lot less if I know I'm fully insured. So I like in my own mind, I think I can reconcile my behavior in those two contexts. But I think one of the advantages of your situation is really online poker players, they should just care about the cash. There really shouldn't be anything else that they care about, I think.
Exactly. So very good comment indeed. And the joy of playing will be the same in those situations where you have the negatively skewed risk and the positively skewed risk. So these examples are very shaky because we change so much at the same time. When we think of a potential disaster that comes with a tiny probability compared to playing a lottery gamble, these are very different situations. And indeed, there might be some joy of playing that also could explain something here. And we think that we can indeed rule that out here in our setting. And you're totally right. In the real world, that changes so much. So indeed, with some joy of playing, etc., you might be able to reconcile EUT with the evidence, which will be not possible, we think, in our setting. Yeah, because we really keep everything the same beside the skewness of the risk people are facing. Any more comments or questions so far? So then let me give you a preview of our results. So we find that online poker players reveal a strong and robust preference for skewness. So we can identify skewness preference here in our setting. Variance seems to play only a very minor role in subjects' choices. So variance is not so important. In expected utility theory, basically all you care about is variance, only skewness plays a minor role. In all these behavioral models, skewness is much more important. Skewness determines whether you like a risk or dislike a risk. And this is what we here also find in our data. We here find that skewness is what matters for your risk attitude, not so much variance. And skewness preferences are most pronounced among experienced players and amongst losing players. So we can make a sample split between those that actually win money and those that lose money in the short or in the long run. And the effect of skewness remains significant also for winning players, in contrast to the variance effect. So the variance effect is not even robust in terms of the sign. The variance effect, thus is actually not there. It's not variance that determines whether you take a risk or not. It's a skewness. And findings are not coherent with expected utility theory, but supportive for behavioral models. And as you said, in real-world settings, not so clear. Some joy of winning could explain things. That's not really the case here, because we keep everything besides skewness the same in the settings. And how we can do that, I'll explain you in the following. So we focus on so-called showdown situations in online poker, and we exploit the introduction of a novel insurance option. What is a showdown? A showdown situation is a situation where some players went all in, and the outcome of this showdown, when some players are all in, cannot be influenced by players and solely depends on the draw of the remaining common cards. Common cards are not there already. So we take a special variant of poker, Omaha poker, but it's actually similar in all poker variants, that whether you win or not depends on your own cards and also on the common cards. The common cards are not there already, at least not all of them. And the common cards that are to be revealed, they determine who wins. So you have now a showdown. Some players went all in, and all relevant information is now actually public, and the probabilities can be easily calculated. You can determine with which cards does player 1 win the showdown situation, and with which cards does player 2 win in this showdown situation. In this showdown, each player faces a binary lottery, can either lose and receive a payoff of 0, or he can win the entire pot. Can either win everything or just lose everything that's in the pot. So the pot means the accumulated bets during a hand. Now, there's a newly introduced insurance option, which is of crucial importance for our study. So this insurance option provides each player the option to choose a safe payoff that equals her expected earning in a showdown minus some margin of 1% that goes to the online casino. So this means when you are in a showdown situation and when only the remaining common cards determine who wins, then you face a binary risk. You can either win the pot or lose. The probabilities that you win and that you lose are displayed on the screen. And now you get the option to exit, and you take your expected value minus this tiny margin. How does it look like? So here we have some screenshot from the online casino from which we retrieved our data. We have several players at the table, and we have here a player we have 2 players all in. We have a pot in the middle that tells us what's the value of the pot in the middle. And then we have player 1 who is all in, and he has a winning chance of 20% with the cards he has at hand. And we have a player 6 in the middle, and we have a player 6 that has an 80% chance of winning. Now we know that, what the probabilities of each of the players is to win here the exact pot. And now now each player can decide whether to play the game or whether to cash out. This is the button down here. You can cash out. You are player 1, and then you take your expected value, which is 20% times the pot of 2.79 minus a 1% margin, or you can resume the hand and then continue to play. So how does it work? The casino, if you quit the game, if you take your cash out option, then the casino takes your hand and plays against the other player. How does it make profit with that? Well, it earns this 1% margin. But the casino then takes the risk, and then on average, in the long run, they don't go bankrupt with this. Of course, you could say, well, the casino knows what's the value of the common card that is to be played. Next common card, the casino can know what that is. Well, the casino doesn't use this information. The casino commits to just continue your game to calculate the real probabilities if the next card is random, and then to give you the expected value based on the next common card being random. Yeah, so
Markus,
these are the two options you have here. Yes?
Markus, Stefan has a question for you.
Sorry,
Yes.
Markus, I'm just not familiar with this game, so I just have a point of information. So do you mean that the outcome of the game is one of these 4 cards in the middle is the one that's chosen, and that's chosen at random, and that determines the outcome? Is that the setup?
No, there's a next card coming, and that determines who wins. And the way poker works here is that you combine some of your own cards with some of the common cards, and then this determines who wins, who has the best sequence. You can have a street or a flush or a royal flush, and what you have depends on your own cards and the common cards. So you combine them, and then you see who has the flush when the other player only has 2 pairs or so. So you have to combine the cards. So it's basically the same in all poker variants. It's just different. How many common cards are there? How many own cards do you have? That's the only difference between all the poker variants. And now the next card could take a value that makes player 1 win, and it could have a value that makes player 6 win. However, the chance that the next card makes player 6 win is much more likely than it makes player 1 win. Why that here on the screenshot? Because player 6 has a pair. He has the 10 on his end, and there's the 10 in the middle, a common card. And I think player 1 has nothing so far. So far, player 6 would win if there's not the right card for player 1. So there's some card with which player 1 could win. Yeah, but so far it looks good for player 6. That's why player 6 is 4 times as likely to win as player 1.
And both
player
players
1 needs a
see
heart.
all the cards. All right. Sorry.
Pardon? Could you say once more?
Both players can see all of the cards. Is that right?
Yes. Yes. Yes.
Okay. Thank you.
Yes, this is the screen of player 1. So we took the screenshot when we were player 1, and then we took this screenshot. So as player 1, in this showdown situation, you see all cards. And these are basically the only situations that we analyze. So there are very many hands, very many different situations that could arise in poker games. We only analyze these 2-player showdown situations, and only these choices here, where you then have the choice between resuming the hand and taking the cash out option. Because these are the situations where you only have 2 options to choose from, the safe option and the risky option with which you continue the gamble, and with which you take a binary risk of winning the pot or losing everything. All other situations are also interesting, but we don't have a clear hypothesis then. in all other poker situations, you have more complicated distributions, you have all kinds of effects that could play a role. But in this situation here, you only have two choices. Resume the hand and wait what's the next common card that determines who wins, or take the cash out option. Just have this binary choice.
How does the cash out work, Markus? Because presumably if it's poker, you just fold, don't you? Because I mean, is it different from? Because I imagine that you choose to fold, or you choose to what's the word? There's not raise, is it? But match the other person. But if you fold, you just get nothing, don't you? How can you get 55 cents?
That's the expected value. The casino offers it to you. It's a new option for people who want to quit this risky situation. The casino offers you, yes, you can quit. You take the expected value. We just calculate the winning probabilities. You could easily calculate them. So the casino calculates them and displays them to you. And then it offers you the expected value, which is just pot times probability minus 1% margin. And you just take the money and then you can play the next hands. And so the casino takes your cards. The casino plays against the other player. You are not affected as a player by the other player quitting. It doesn't matter for player 1 whether player 6 here takes the cash out option or not. It doesn't matter. The casino takes the hands.
But it doesn't mean that the pot then becomes 279 minus 55 cents.
No.
Okay.
Each player is totally independent from the choices of the other. It's just a kind of secret deal between each player and the casino. The casino offers the player, I buy your cards, you get 55 cents, and then I continue to play for you. It doesn't change the situation of the other one. This is also an advantage of the situation here. It's kind of a secret deal between each player and the casino. Do you want to sell me, the casino, your hands? I play for you, and then you get this cash out, or do you yourself want to continue the game?
Cool, thanks.
So that's why each of the players is totally independent from the choice of the other player. And the casino itself makes not much profit with it, but a bit, because when you choose the cash out option, it gets the 1% margin. Then in expectation, of course, if you have 1 million games, then sometimes the casino, if it buys the hand, will win, sometimes lose, but in the long run, these effects cancel out and the 1% margin of the casino remains.
So yeah, James, there's no other decisions for the players to make after this, because player 1 is all in. So all the betting and folding and raising, that's already happened in this hand. So this is just the money's gone in, and now you have a chance to buy insurance if you want. Exactly.
Just this binary change is the last change that you can do here. And it's as close as possible to a lab setting. Of course, you could say it's not random. It's not totally random whether you end up in these situations or not. In the laboratory, it would be random whether you are in such a situation. This is not the case here. Of course, it depends on your former choices whether you end up in these situations. And we try our best to investigate whether this creates some distortions. We don't think so. But of course, that's a limitation, because with your own choices, you affect whether you end up in such a situation, and also which probabilities do you have. But yeah, we run several robustness checks I show you in the following to assure as good as possible that this doesn't create too much distortions here. Yeah, but this situation here is quite special, and we can only analyze these showdown situations so nicely here because of this cash out option that was only introduced 2 or 3 years ago. at this online casino. I think other online. So we have the data from the largest online casino in the world, but I think by now also other online casinos have adopted this practice of offering this cash out insurance option. So this is the choice situation. And then let me just briefly explain you the theoretical background. I'm very brief on this, and then I come to the data and the results. So binary risk with outcome x1 realized with probability pi and outcome x2 realized with probability 1 minus pi can be determined by 3 moments. So you can write a lottery like this with the probabilities and the respective outcomes, or you characterize the binary risk equivalently via these 3 moments: expected value, variance, and skewness. So each binary risk you can either write down like this here with the outcomes and probabilities, or via the moments. Because you can write each risk as a function of the 3 moments, and it's unique for each 3 moments. There is just one binary lottery precisely defined by them. You can also just change one moment at the same time. So fix the other moments, then just vary one moment. And that's how you can test for skewness effects in a lab experiment. You fix E, you fix V, and then you just change skewness. So that's how you can clearly identify higher order risk preferences, so skewness preference here. So the conventional wisdom in choice under risk is that people face a trade-off between a higher expected value and lower variance. So people want a high expected value, but also low variance, and they may accept a lower expected value in order to avoid variance. This is the conventional wisdom in the EUT world. This, however, can be overturned by skewness preferences. So in the behavioral world, people like positively skewed but dislike negatively skewed risks. And this is also supported, as I said, by quite some data, and we will also provide support for this with our poker setting. So how could you formally define skewness preferences? So for any expected value and any variance, an agent reveals a preference for skewness if she prefers the binary lottery over the safe option that pays exactly the expected value, if and only if the skewness level is sufficiently large. So you start to prefer the gamble if skewness is sufficiently large. If skewness is not large, you want to go for the safe option that pays the expected value. For instance, if the lottery is just symmetric, you want to take the expected value, but when skewness is sufficiently positive, then you choose the skewed risks. This is skewness preferences, and this is a prediction that's shared by many behavioral models. We don't focus here on a specific behavioral models. It's not that we say we test prospect theory against all other models, etc. We just test skewness preferences as a whole, as predicted by salience, regret, prospect theory, etc., against the standard approach of EUT. So in our setup, skewness preferences would predict a negative relation between insurance choice and the lottery skewness if we keep all other moments constant. So negative relation means that you should be more likely to choose the insurance choice when you have a negatively skewed distribution. Positively skewed distributions are those with the tiny risk to win. So you have a tiny probability of winning the entire pot. These are positively skewed risks, and those with the large probability to win, these are the negatively skewed risks. So coming back to the screenshot here, player 1 faces a positively skewed risk, and player 6 faces a negatively skewed risk. So the logic is here, the logic of skewness preferences. Player 1 wants to stay in the game because he has a quite small probability of winning the pot, but he can win $3, whereas the save option is just 55 cents. That's not so attractive for him. For player 6, the logic is different. His cash out option would be about 230 or so. Player 6 can take the 230 sure, or he can take the risk of maybe winning 279, but maybe also losing everything. Agent that dislikes negative skewness, player 6 will choose the cash out option. That's a prediction by Skewness Preference. Player 6 can only gain a bit by staying in the game, but he can also lose everything. And that's why player 6 likes the cash out, and player 1 doesn't like the cash out. The cash out is so low, he rather wants to stay in the game to win the entire pot, whereas player 6 rather wants to quit the game to and take the cash out that's quite sizable compared to the pot. The cash out is 230, the entire pot is 280, so yeah, let's go for the cash out. That's the logic of Skewness Preferences here in this situation depicted on the screenshot. Some stylized example here. Let's suppose we have an expected value of 108 and we have two risks with the same variance but just opposite sign of skewness. This is basically a stylized situation, a stylized version of the situation on the screenshot. On the left-hand side, you can decide for the 108 safe, or you can take this gamble. You can take 120 with 90% probability, or you lose everything. Well, according to Skewness Preferences, as also for the situation on the screenshot, you will choose a save option. You can just gain a bit. You can just gain 12 more euro by taking the risk, but on the other hand, you really risk a lot. You can also lose everything with this small probability. As an agent who likes skewness, you don't like this risk. You take the save option. And this is different here on the right-hand side. On the right-hand side, you also have expected value 108, but here you have a right skewed risk. Right skewed means with 10% probability, you can gain a lot. With 90% probability, you only win 96 euros. And here, an agent who likes skewness, he will choose the risk. He doesn't want to take the 108 for sure, because by choosing the risk, he can get the very large value and he doesn't lose too much in the other case. These two risks are constructed exactly so that the expected value is the same, that the variance is the same, and just that skewness has the opposite sign. And this is exactly the situation that people also face here in the poker game. This is the same here. Both players have, well, not exactly. The expected values here are different, but the variance is the same and the sign of the skewness is the same. The expected value here, of course, for player 6 is larger than for player 1. That's one thing we can't keep the same as in a lab experiment. In a lab experiment, we can really control for everything. We can fix E, we can fix the variance and then just change the sign of the skewness. Here, both players have the same variance and they have exactly the opposite sign of skewness. But they also have different expected values. But the expected value actually shouldn't change a lot. In none of the models, the expected value should matter much, because with the expected value, you increase the safe option and the risk likewise. So no matter whether I write here 108 or 208 or 150, if I increase all payoffs likewise, E shouldn't play much of a role, neither in expected utility theory nor in the behavioral models, because we kind of fixed E. We also fixed it here. If we increase expected value, we increase also the cash out option. because the cash out option is exactly the expected value minus this tiny 1% margin. Hope that's clear. So we come as close as possible to this perfect lab situation where we can cleanly identify skewness effects, because here we just change skewness between these two situations, and then people on the left-hand side choose safe and on the right-hand side choose the risk. Then we get choice patterns that contradict expected utility theory and that are in line with skewness preferences. And we come as close as possible to this situation in our field poker setting. Any questions so far? Hope you could follow the theoretical concept and how we want to mirror that in our choice situation that we're analyzing here. So what's the data set we're having? We analyze the Omaha variant of poker, and we have all in all more than 35 million distinct Omaha poker cash game hands played in time range of 18 months on PokerStars, the largest online casino. We have more than 4 million observations, and here each observation refers to a unique decision by a single player in a two-person showdown situation. So these here, the 35 million, are all hands, but we are not interested in all hands. We are only interested in those hands that end up in a two-person showdown situation. We don't want to have a three-person showdown situation, because then the risk is more complicated and 3 people can win. We just want to focus on these very simple situations where there are just 2 players that can win or lose. And if the one player wins, the other player loses. And we have in our data set then still more than 4 million of these situations that we are interested in here. Then we have a panel of more than 80,000 distinct players. So these observations belong to more than 80,000 distinct players that play poker repeatedly over this 18-month period. And as a consequence, we have this panel structure. And this means that, yeah, players make repeated choices. And there's also much within subject variance. So the probabilities each player sees and also the payouts each player enjoys vary a lot within subject. So each of the players here takes part in quite different showdown situations. So we have more than one showdown situation, quite a substantial number of showdown situations for many players. And we can also split the sample according to in how many showdown situations did the player take part. So we have a quite rich data set, also rich in the sense of the observations that we are here interested in. We run our analysis on the raw data from a commercial poker player provider that collects and stores hand histories from poker cash games played on PokerStars. So there's a commercial poker data provider that gathers this data. There are not only researchers interested in this poker data, also others, and that's why also poker players themselves, for instance, and that's why there are commercial poker data providers. Yeah, we take the raw data and then run our regressions on that. So first, an overview of the descriptives here of the main variables of interest. So we have more than 4 million showdown situations. The insurance was chosen in around 17% of the cases. The insurance wasn't chosen so often, could be explained by the 1% margin, could also be explained by players not being very intrinsically risk averse. make sense. Well, poker players play the game to engage in some risks. These are not those who have an intrinsic very high level of risk aversion. But the cash out option is chosen in decent number of cases, so we can analyze when is the insurance option chosen. It's not that it's never chosen, it's in 17% of the cases, so more than 700,000 times players selected this cash out option. Then we can look into the probability moments of insurance choice. So what are the expected values, what are the variances and the skewness values we see here. Mean expected value is more than 60, so it's a substantial pot size that we're analyzing here. Variance of the game differs substantially. In skewness, of course, the mean of skewness must be 0. Why? Because for each positive skewness value, we also have a negative skewness value. So this game here for player 1 has a skewness value of +3, let's say. Then the risk for player 6 has a skewness value of -3. Only the sign switches. That's easy to see from the formula how you calculate skewness. So for every positively skewed game, there's also the negatively skewed game with just the opposite sign. And it's just the other player that takes part in the showdown that has this game with the other sign skewness. So that's why the mean of skewness here is 0. So for each right skewed lottery, there is exactly one complementary left skewed lottery with the counter winning probability, and variance is identical for these two risks, and only skewness differs in terms of the sign. So what do we find then? What's the first result table? Here we see the skewness effects already quite nicely. So here we write down the share of insurance choices for the different winning probability ranges. So we group together different winning probabilities. Here, winning probabilities between 0% and 10%, between 10% and 20, 20 and 30, 30 and 40, and 40 and 50%. And here on the y-axis, we write down the share of the insurance choices. And then we distinguish whether the risk is right skewed or whether the risk is left skewed. And then we see that for each of the probability ranges, the blue bars are significantly higher than the red bars. You also see here the confidence intervals that are very narrow because of the huge sample size that we have here. So very significant differences in shares of insurance choices for left skewed and right skewed risks for all these different intervals. That means subjects who face a negatively skewed lottery choose the insurance option in about 20% of the cases. Subjects who face a positively skewed risk do so in only 14% of the case, and the difference is very significant. So people are much more likely to choose the insurance option when the risk they are facing is left skewed compared to situations where the risk that are facing is right skewed. So these are only the descriptives. Now we want to control for different things, for player fixed effects, for the expected value of the game, and so on and so forth. How do we do that? We estimate a regression, and this follows Mitten and Forking, some quite well-known financial paper, and they assume that utility is linear and risk moments. So they use some kind of reduced form behavioral model whereby people dislike variance but like skewness. So it's an easy behavioral model that we could here now use for our regression analysis. So what is then the regression that we're estimating? We're estimating following reduced form equation with player I and decision J, and then we can or we want to see when do people choose the insurance. So we have an insurance choice dummy here as the dependent variable, and then as the independent variables, we have the expected value, the variance, and the skewness. These three moments uniquely characterize the risk that people face. They face a binary risk, which is uniquely determined by these three moments. And then we control for player-specific characteristics, for hand-specific characteristics, for time fixed effects, stake fixed effects, player fixed effects. We could include all of that because we have so much data. So what are the regression results that we find then? We here include different controls. That's why we have here 4 columns, but the effects are quite robust across specifications. Expected value is quite significant. Variance, the variance effect is not so clear, tiny coefficient, and not so significant. And the skewness effect is very significant and also quite substantial. And the constant gives us our baseline value of 17%, with which people choose the insurance on average. And this coefficient tells us then that if we increase skewness, then people are less likely to choose the insurance option. And if we increase the expected value, then people are a bit more likely to choose the insurance option. But as I said, the expected value is actually not so interesting because with the expected value, not only do the payoffs of the risk increase, also the alternative, the cash out option, also increases because it is exactly the expected value minus the 1% margin. That's why actually none of the models, neither expected utility theory nor any of the behavioral models, makes here a strong prediction. But what's interesting is that the skewness effect is stronger than the variance effect. Now we could run various sample splits. We can, for instance, split the sample according to the experience of the players. So we could look at inexperienced players and at experienced players. How do we define experience? We could say that those that had so we can make sample splits according to the number of showdowns people faced or according to the hands people played. Now, if we take the inexperienced players in terms of showdowns, so those that didn't face so many showdowns, we have this graph here, still very significant skewness effects here for all intervals. But if we look at the experienced players that faced many showdowns, the skewness effects are even stronger. And this suggests that skewness preferences are not due to a misunderstanding. It seems to be really about what the term also says. It's a preference for skewness. People want to take the skewed risks. It's not just a misunderstanding. Experienced players who are very experienced with risks, they also choose skewness or skewed risks, which really suggests that like teaching, giving players more experience doesn't eliminate these effects. For many behavioral biases, there's the question, could you teach people that they don't reveal them anymore? This here doesn't seem to be something that goes away with experience. This suggests that this is maybe not a bias. It's really a preference for skewed risks. Now we could define experience also according to the number of hands played, and then we see the same pattern. Again, both groups reveal skewness preferences, but the experienced players have a stronger preference for skewness. Now we can also run our regressions for the inexperienced players and the experienced players. We can include all kinds of fixed effects. We can also look at the profits players make. So we can look at the average profit per 100 hands played. You could look at those players that win on average, that go home with a net win. And you could look at the losing players. And yeah, then we see basically that across all specifications, skewness is very significant. The skewness effect is there. It's stronger for losing players than for winning players. Coefficients are stronger. And for experienced players, those that play a lot, skewness effects are particularly large. So we can run a range of robustness checks. We can, for instance, exclude all hands that resulted in a split pot. Something that I was silent on so far is that for specific combinations of hands, a split pot is also possible. It could be the case that the pot, is just split, that both get half. This can't. It's not the case that this can always happen, but sometimes this could happen in principle. So the risk is not always binary. But on the screen, it's actually displayed as if it's binary. So this split pot possibility is actually quite rare, and we don't think that this creates a confound here. If we exclude those games that resulted in a split pot, none of our results change. So we don't think that the split pot thing here is a big problem for us. Then we can run the regressions with non-standardized independent variables. So far, we standardized the variables, but this also doesn't really affect our results. We could, instead of an OLS, run logit or probit specifications. Also doesn't change things. We could exclude some outliers, which doesn't change the main results. We could, instead of expected value and variance, use the inverse Sharpe ratio, well known in the finance literature. Also doesn't affect the results by much. Or we could consider only those players that faced both types of lotteries, the left and the right skewed lotteries, at least once. Otherwise, you might say, well, it's just substantially different people who end up in these right skewed risk situations and these left skewed risk situations. That's actually not the case. For instance, we exclude all kind of fixed effects, but also if we exclude those very few players that only face one type of risk in the showdown situation, also then our results stay the same. And we can also exclude all observations of players who never or always choose the insurance option, so it's also not driven by these extreme players. And then to conclude, we find that the introduction of the insurance option gives us a perfect setup to cleanly test for skewness preferences in a large and unique data set with observational panel data. It's not as clean as in the laboratory, but we think it's much cleaner than in the existing studies on skewness effects that use observational data. We find a strong and robust evidence for skewness preference, both in qualitative as well as in quantitative terms. The effect of skewness is strongest for experienced and losing players, but it's actually significant in all kinds of sample splits that we conducted. Variance plays only a minor role in our data, and we think that skewness preferences are a very interesting topic to study because they are also important for workers, investors, entrepreneurs. They are important in all kinds of situations. We don't think that poker decision making is so interesting in itself, but if it learns us, if it teaches us how people make actually choices under risk, then we can learn also what affects their risk taking in other more interesting or more important situations in life. And that's why we think that this is a interesting question to study. So thank you for your attention. That's it from my side. And of course, I'm happy also to take your questions.
Great. Thank you very much, Markus. That was really very good. I can see some people have reacted with applause, so I'm going to do the same as well. There's a team's applause. We've got Ian Gregory Smith, who'd got his hand up even before you'd finished talking, Markus. So Ian was very keen for this question. Go ahead, Ian.
Hi. So I don't know if you mentioned this with the robustness. So I guess one behavioral thing that poker players are aware of, so I dabble in online poker from time to time, is that there's this tendency to try to lock up a win. So if you're ahead of the stack that you started the game at, there's this tendency to try to play a little bit tighter or whatever to ensure that you remain above that stack size. And likewise, if you are behind, you don't really mind going to zero because you can always buy back in, whereas you can never add on in a cash game. And there's a strategic advantage to having more money on the table than other people, because it allows you the possibility to put pressure on other players and stuff. So I don't know if that is able, if you're able to take that into account in terms of the preferences for why you would sort of you would behave more cautiously when the probability is in your favor versus behind. I see. If that's something you can take care of or not.
I see. Not sure whether we checked that already, but my co-authors who are also participating have to write that down. I myself actually not a poker player at all, so I have no clue what of what's important for the poker players that play there. What matters for them, but I agree that this could be interesting thing to also check here as a robustness check.
So yeah, I was fumbling between two different points there. So one is that there may be a behavioral bias to be ahead of your starting stack, which, so if you watch sort of poker training sites, they tell you don't do that because you're giving up money. But it's a thing, right? So it's a thing that a lot of people experience. And then the second is a real sort of positive advantage of having more money on the table than anybody else, because it allows you to play in a way that's going to be better. You're going to make more money.
I see.
You have a strategic advantage if you do that.
Okay. Yeah, this means that we should really check control for these things. Yes.
I mean, really good players should never be taking this option because you're burning 1% on every time you do it. So you really should just take your equity.
Johannes, you are muted. Yes?
Yeah, I mean, do you hear me? Maybe I can reply to that. So what we did is we split the sample on players who basically risk all their stack, and we see very similar effects. So following your logic, you would expect that people who have higher stack size would behave differently. And then obviously, if we look at the winning players, then following your story, you would expect that they don't show any skewness preferences, and you're completely right. And that's something that actually a good poker player makes risk neutral decisions in a way. So we shouldn't expect like huge effects both of variance and skewness here. While we find that the variance like vanishes for these players, the skewness effect is still there. And then regarding these strategic considerations, they should mainly matter before you go to a showdown, but not once you are in the showdown and where you actually can't affect the outcome of the game anymore. And what is true, and you're probably aware of that you can actually top up in the cash game also. You can top up to the maximum amount that you can enter the table. So
so that's my point though. So if you're above that amount, then you cannot top up any further, whereas you can if you go below.
That's a good point. I think we should double check what happens if we are like far away of the maximum amount that you could bring to the table at the beginning. If there's maybe some strategic, which would
so you see
relate to a reference point
sort of
theory.
low stake tournaments where you can rebuy into the tournament. So people will go crazy in the early stages of a tournament in order to build up a big stack, knowing that they can rebuy into the tournament, but you can't add on to your stack when you're already in the tournament. So it incentivizes more sort of loose behavior when you're
But we're not looking at tournament plays.
I know, but it's the same sort of behavioral thing that you would experience in a cash game. This ability to top up when you go to 0, but not add on when you are above the maximum limit.
I mean, that's definitely a good thing that we should check. And what I would argue is that then usually if you have like a large stack, then most of the time your opponent who is all in has not that much in chips. So there are really only few observations where you would really like experience a huge loss to your stack. But that would be definitely an interesting group to look at to also explain more about the mechanisms. Yeah, thanks a lot for the great comment. We'll check that.
Yeah, great, Johannes. He's the expert for poker, so very good that you could here react to the questions of the experts.
Perfect, thanks, Ian. Pete has his hand up with a question.
I have a couple of questions. First of all, your sample size is so huge that the statistical significance is going to always be there. So I'd like you to kind of interpret the magnitudes a bit better. I'm trying to figure out what exactly does that mean when the skewness is 0.0. So it would be useful to the reader or down the road when you have the paper to know exactly how much it changes with that skewness. And the other concern I have is it's a selected sample. These are only people who enjoy poker, of course, and they generally are risk-loving to begin with. And so I'm just curious how you're going to control or explain, well, not explain that, but just be aware of that. But I enjoyed the paper very much. Thank you.
Yeah, so we standardized our coefficients to make the coefficients for variance, skewness, etc. somewhat comparable. And yes, of course, we have a very selected sample of people, of poker players, but basically that's always the case for empirical studies. So other empirical studies, so the finance studies, they take only investors into certain stocks into account, or yeah, well, we have a selected sample, but yeah, it's necessarily basically the case in all kinds of these observational studies. And because we can split people according to the experience, so the inexperienced one may be more average people that play once in a while, and the expert people, those with a lot of experience, maybe more those that are quite special.
Or they just enjoy it more.
Yeah, could also be.
But yeah, thank you so much. Enjoyed it.
Yeah, that's for sure not me. So I only played it once with Johannes and Dimi to get a bit of a feeling for the game. I actually also liked it, but nevertheless, I never logged in again.
Okay, thanks, Pete. Any more questions and comments? I was going to ask you a fairly kind of standard question, I guess, which is you've got lots of individual players. Do you know anything about them other than how many times they've played before?
Not really. So they don't have to enter a lot. Right, Johannes? Or do we know some more things?
No, I mean, if we, for example, do the subsample splits along experience, we use exactly the number of hands played by that players during that observation period. And what we can also do, we can basically track them, how many sessions they play, or it may play in parallel. However, that's quite tedious data work, so we haven't done that yet. But what we've done is to look at the number of hands played and also the number of showdown situations.
But we don't know like the socio-demographic background or something like that. We have no clue.
No, unfortunately, we don't know anything. Except
they don't have to enter that, and that's why we have no clue.
maybe do you have a username? I guess, do you?
Yeah, but we can't get too much out of that.
Do some text analysis, natural language processing on the usernames. See what you could pull up from them. Anyway, just random thoughts.
Maybe
Go on. Sorry.
So yeah, maybe we could also maybe use the time of a day where they're playing to say whether they're from Australia or from, I don't know, Canada or from Europe. But then again, poker players like to play at night, so it's probably hard to make a story there.
Stefan's got his hand up.
Hi. Yeah, I thought that was really interesting. Thank you very much. I had a couple of questions. So first, if I got it right, the average value was $60 at stake. It was dollars, right? And the variance was 320, if I was seeing that right, which is quite large. So I just wondered. So I wondered if there was, there was clearly some very big pots in here, and I was wondering whether there was anything noticeable about when there were actually really very large sums of money at stake. And then the second thing was I was wondering, I mean, you know about this, who's doing what? So did all the other poker players know about people's choices? So I guess my question is there any component of signaling going on here potentially?
So yeah, thank you for the questions. The variance is quite large. Yes, because you can always lose everything. So you can win the entire pot or lose everything, which I think creates quite large variance, but it's just a very simple formula of how to calculate here the variances, but we also have quite substantial pots here. So, and the second question, signaling, well, in the showdown situations, you have no clue whether the other player continues or not. And it's also not important for each of the players to know, does the other player continue here or does he quit? Does the casino take over the hands? This is not important for the player. So if you are in a showdown, it doesn't matter at all whether the other player continues or not. Either the casino takes the hands and plays against you or the player himself. So in these situations, I think it's not important anymore. Of course, there could be players who know each other already quite well that could affect, do I want to go all in if I know the other player is at the table? Such effects in principle could play some role. I wouldn't know how we could rule that out. We could, for instance, then look at the skewness effects for people who never played with each other hands before, something like that. I think we might be able to do in principle. So are there only strangers at the table?
Right. I mean, just a simple question is how common is it for people to know the other people that are playing at the table? Is that very common or not common at all? I mean,
I've also
if it's very common, then I'd expect signaling to be an issue.
Yeah. Johannes, do you know?
So, I mean, you can observe as a player whether the other person took the insurance or not. However, and that may have like signaling effects for, I think, the strategic behavior in subsequent hands. However, again, like looking at the pure showdown situation where you don't have any strategic component anymore, I wouldn't expect like a large bias, but in principle, like you mean like a stigma effect that by taking the insurance, you show other players that you're risk-averse players that might be exploited later. So we cannot perfectly, I guess, rule that out. Maybe we could definitely look at maybe the first time where people play against each other. But that's actually a good point. Thank you. Thank you so much.
No, really great.
Great. Thanks, Stefan. You kind of have, I think you've answered it implicitly. I'm not familiar with the Omaha poker. You've got, it looks like when the final card comes out, you've got 4 in your hand and 5 on the table. And you then take the best 5 from those 9 cards. And I guess maybe the question then is, issue with that aspect is, when you get to the end, does the computer select for you what your best 5 from the 9 is? Because I do ask whether mistakes happen, because if I was playing it and I was a beginner, I might make a mistake over what's the best hand in.
No. It's automatically selected by the computer, and that's also the way how the computer could write down the winning probabilities, because he knows I'm selecting the best cards for you. Otherwise, the computer wouldn't be able to write down the winning probabilities, because he had to incorporate also that you might overlook something, that you do a mistake, etc. No, that's automatic.
Okay, well, I'm going to assume that people might want to go at 4 o'clock to watch the next World Cup match, and so we've got time for one more question, if anyone has a question.
By the way, this was the first time I presented this paper, but it's really fun presenting it, so I should present it more often. Very nice that you contacted me to present the paper here.
I've often thought it would be really nice to see, it must be the case that you can get data from online poker. So it's nice to see a paper using that and analyzing it really well.
People asked me, you're presenting in a sports seminar, is this really sports? And I said, well, if chess is sports and darts is sports, and then I was discussing with people, where is the limit of what is sports and what's not sports anymore?
This is a question I got as well when I told someone it was a poker talk taking place.
You don't want to get involved in this. It's horrible. It's nasty. It ends up being very unpleasant. I would just say, what else? They told me it was. That was right.
Exactly. I asked you, so therefore it must be a sport. So. Great. Okay. Well, we'll wrap up then. Say thank you very much, Markus, and to your co-authors as well for a really interesting paper, and thank you everyone else for your contributions. We obviously are now stopping to watch the Netherlands face Ecuador, which will be an interesting game. And then we come back next week when we have Christian Rutzia, back to football, making a Maradona, meat consumption and soccer prowess. So look forward to next week, and hopefully we enjoy some football in the meantime.
Yeah, thank you. Bye.
Cheers.